Hello, my name is Phil Case, and I will be talking about an article written by the Assistant Vice President of the Federal Reserve Bank of New York's Research and Statistics Group, Mary Amidi. The article is titled The Effect of a Strong Dollar on U.S. Growth. So, the rise of the dollar. Now, what exactly does that mean? That means our currency, US dollar, appreciates in relation to other currencies around the globe. And in the past year, approximately, our US dollar appreciated 12%, and we saw the largest changes against Japan, Mexico, Canada, and the Euro area. And those are some of our largest trading partners in the world. I think those are all in the top 5, if not the top 10. And we did see little movement of the USD against currencies in Asian countries. And because Japan, Mexico, Canada are our largest trading partners, I'll talk about how this strong dollar does have a negative impact on gross domestic product. So, taking a look at some examples here, the article goes over some kind of apples to apples comparisons, right? So we look at a 10% appreciation of the US dollar and what that means to different factors from a macroeconomic level. So they found that 10% appreciation in US dollars results in a 0.5% decline in GDP in year 1 and a 0.7% decline in GDP in year 2. And there are many factors that contribute to a successful or a growing or declining gross domestic product, but in this study we're specifically looking at trade balance. And a trade surplus is when we export more products than we import, and a trade deficit is when we import more products than we export. And based on July 2015's numbers, we can see that we have a trade deficit of $41.9 billion. That means we imported more than we exported, and you can see right there we imported $230.4 billion and exported only $188.5 billion worth of products. So the strength of the dollar, I'll first take a look at some of the impacts to importing. So when we have a strong US dollar, it is cheaper for domestic consumers to buy foreign products or import products. Or like I said, if we travel to another country, our dollars purchase more, they have more buying power in other countries. Though this doesn't necessarily translate to lower prices to US consumers. In the study they saw that per 10% appreciation in the US dollar, non-oil import prices only decreased by 3.8%, because foreign exporters know that through a strong dollar they can increase their margins and US consumers can afford it, or US importers can afford it. And so then we can see that a 10% in the appreciation of the US dollar only results in just under 1% increase in real import values. So that increase in US dollar really doesn't bring in more imports or as many imports as you would think. Now the bigger impact is the declining growth in exports via the strong US dollar, and we can see that growth has halved in 2009 to 2014 compared to 2003 to 2008. And through July of 2015, exports are down 3.5% from the same time in 2014. Because the strong US dollar decreases foreign demand for US products. Why does that happen? Well, if the US dollar is stronger against other currencies, it takes more of that currency to buy anything in a US dollar. So companies that operate in local currencies, for example, Harley Davidson, if we operate in Germany, we'd sell it in the euro, and that euro now buys less US dollars. So when that money comes back into the US, we have less profit per the same unit that we've sold over there. And we can see that a 10% appreciation in the US dollar results in export values dropping by 2.6% in the same year. So a 10% appreciation in the dollar has a bigger negative impact on exporting than it does positive impact on importing. And this document right here shows a summary of the cumulative change regarding real export values, import values, and GDP growth or declining based on a 10% appreciation. So what can managers do? What can companies do? A few different options listed here. One option is to scale back international operations and exports or completely stop operating internationally. Obviously, without operating in another country or scaling back, you are decreasing your risk to currency fluctuation, but you're also losing market share. If you continue business internationally, change nothing here. You can maintain your market share though, but there's less profit. And the manager might have to look at what matters more, obtaining market share or losing money. Once the economy grows stronger again, maybe it would cost more money to regain that market share than it would just lose that profit up front right now. Another option is to sell only in US dollars to foreign buyers because this completely eliminates currency fluctuation. They're still buying in US dollars. You're not translating currency. You're doing no foreign exchange. So this maintains your profit levels from US dollar perspective. The big risk here is losing your business to buyers who are more flexible for competitors, because if you're only selling in US dollars, that product becomes more expensive for the consumer in the other country, so they might not necessarily want to do that. So another option is potentially pricing products differently in different markets. For example, you could have a different price for a motorcycle or whatever it is in Germany versus South Korea, because South Korean currencies tend not to fluctuate as much against the US dollar. So based on these recommendations and this talk, I'd like to hear about how you would manage this risk internally. Thank you.